Hi everybody, my name is Bookie and I'm here for the Good Eve channel. So today I want us to talk about key investment terms. And why are we going to talk about key investment terms? Because if we don't know what they are, then we don't know what we can invest in. And although I'm sure most of you know most of these things in one form or the other, I think it's important to have a video where in one place you can kind of look over and just refresh your memory about some of these terms. So if you know what these are, well, comment below to see if I got them right. And if you don't know what these are, comment below and let me know, what do you think about some of these definitions? So the first one I'd like to talk about, and we keep hearing these buzzwords and they keep coming up. Key investment term is high yield savings accounts. Everyone talks about this. Don't just put your money in a saving account. Put it in a high interest yielding savings account. So I'm going to break this down. High interest. Interest is the money you get paid on top of the money you've put in a bank. So high interest means you get more interest than traditionally you would get. Now this phrase is commonly used in the United States of America more popularly. So on average, a high interest yielding savings account at this time in 2021 would yield you about 3% or above. Now in Nigeria, that would be the interest rate for a regular interest account. So if you're thinking about, some banks have products that give you a little bit more interest, 5 to 6%. And then there are usually rules that come with high interest savings accounts. Maybe you have a certain limited number of withdrawals in a month. And there are other terms and conditions. So if you're considering doing that, please, look up. I'm not going to recommend any provider in this video, but do your research, ask harder questions, because sometimes there are terms and conditions that apply. A second term I'd like us to talk about are certificates of deposit. Now the word CD or certificates of deposit, I don't mean music. I mean certificates of deposit. So deposit that they're referring to, the word deposit is another description for money. So it's a certificate for money you've deposited with the bank. And this is a commonly used American term also. Now in the Nigerian parlance, the word we'd use is fixed deposit. So you fixed a deposit of your money in a bank for a period of time, and they give you a guaranteed interest return. It's also referred to commonly as fixed income. Income also being referenced to money. I don't know why they just don't call it fixed money investment or something. I mean, that might be easier for people to understand. Anyway, we all know that banks and financial institutions make money from confusing us at every corner they get. So what is a certificate of deposit, fixed deposit, fixed income, or as I would call it, fixed money, and they give you interest, is basically you give them an amount of money, let's say $100, and then they agree, I'm going to fix it, leave this money with you untouched, unhindered, for a period of time, a fixed specified period of time, which we know at the beginning of taking this investment. So for instance, it's common to see fixed deposits or certificate of deposits or fixed income investments for durations, that's the time period of 3 months, 6 months, 9 months, even a year. And what will happen is they'll offer you an interest rate that's annualized or prorated over a year. So rates could vary from 3% to 5% to 10%, depending on which country and which banking institution that you are investing with. Now we're finding some of the more virtual lenders, the online banks, tend to offer higher rates. Part of the reason for this could potentially be because, well, they don't have the physical infrastructure that you find with a more traditional bank. But I also think a large part of it also is because they're not as tested or true as your traditional brick and mortar physical located banks. And so the truth is, if your online bank disappears tomorrow, you don't have that feeling of security to say, I can walk into this branch, I know the manager, I know the person at the teller or the desk, and I can ask them what happened to my money. All that happens with an online institution is that, well, I guess it goes offline, and you're there wondering to yourself, how did this happen to me? But we know that virtual seems to be the way of the future, and I'm sure 10, 15 years from now, they'll be charging rates as similarly as traditional brick and mortar banks are charging us today. So I want to talk about, there's a common term we hear being thrown around, and it says, I own a stock, or I own stock, or he owns shares, or he has an investment, or he has equity in a company. Now, when we talk about what is a stock, what are shares, so this is the way I'm going to have you think about it, because really those words don't really mean much. So think about it this way. You go to your local supermarket, your corner store, that store that's close to you in your house, and you're talking to your favorites, the store owner, you're chatting up with Mr. Joe. And Mr. Joe tells you, you know what, I have 100 slots, units, and those 100 units make up the value of this supermarket. And you're like, oh, really? So how does that work with the inventory? No. The inventory is owned holistically by the entity that is the supermarket, but the ownership of the supermarket is split into 100 units. And I, Mr. Joe, I own 50 of those 100 units. Now, if you think about this concept, and so, okay, Mr. Joe, can I have a unit? And he goes, yes, you can have one unit. Mr. Joe still owns 50, you own one. So Mr. Joe, what's the benefit of me owning this unit? Well, he goes, you pay for it, which means you're going to pay in money into the company, which will add to use to buy more inventory or to do capital projects or whatnot. And then after a few years, we'll use the money to trade and grow. We may pay you a dividend, or the value of that unit, let's say you bought that unit for $1, maybe after 5 years, the value of that one unit that you own has become $5. Now, do you own the entire supermarket by yourself? No. But do you own a piece of the supermarket? Yes. And that's the idea. And the idea of owning shares or stocks or equity in this example is Mr. Joe will continue working that business. He needs additional investment so he can grow the business, expand, perhaps even open up bigger branches, maybe expand the size of his physical store. But you get to put in some money, and all you have to do is show up maybe for the annual general meeting or read the reports or decide, oh, some other units are coming available, I want to invest. And after a while, you get rewarded with a dividend. A dividend happens when, for instance, that business declares a profit and you get a piece of that profit proportional to your unit. That unit is what is commonly referred to as shares, as stocks. In the Nigerian context, we are often familiar with people come together and they have an investment or they have a building or they have something they want to do and they split it into the word slots. And they'll say there are 10 slots of this. Do you want a slot? A slot in this context is the same thing as a share. It's the closest thing I can use to explain it. So if someone has 2 slots, they have 2 shares or 2 stocks. So that's really how it works for these larger million, billion, trillion-dollar businesses. So when you hear equity, equity means you are a part owner. Even if your ownership is minuscule, tiny, just a little bit, But it's not a loan. You can't go to the company today and say, Mr. Joe, I want my money back for that one unit. Mr. Joe may not be able to sell it. He may not, if Mr. Joe doesn't buy the unit from you, he may say, I don't have the money to buy any more units. You must sell it to someone else. You have to find a third party that wants to buy that unit from you. So that is the concept of shares, of stocks, of equity. Equity means you're a part owner. Now, what has happened is the example of Mr. Joe is a smaller example of maybe a privately held company, i.e., that company is not listed on an exchange. And so usually when people talk about S&P 500 or S&P Standard & Poor's is just like an organization that tracks the performance. How do big conglomerate, multinational, massive American businesses which are listed on the New York Stock Exchange, how do they behave? All right, let me take a step back and explain that again, because I've said a couple of terms that have probably muddied the waters. So I gave the example of Mr. Joe and his supermarket, right? Good. So in his case, if you want to buy his shares, you have to probably go to Mr. Joe, and that is where you go. In the context of the New York Stock Exchange, Mr. Joe's supermarket would most likely not be listed. But many of us have heard of a company called Walmart, right? And Walmart, even though there's not a Walmart in Nigeria or outside Europe and the US, we are familiar with large supermarket chains. In Nigeria, for instance, we'd be familiar with ShopRite, for instance. Now, unfortunately, ShopRite in Nigeria is also not listed on an exchange, but at least we get the idea of in terms of size. So let me give you an example of Walmart. So Walmart, for instance, could have, and I'm just guessing here, I don't know how many shares, how many shares they have, but let's say they have 1 billion slots, units, pieces of shares that individual investors can buy. So I, for instance, could choose to buy 100,000 slots, units, shares of their company. Now, all of us, because remember I said they have 1 billion slots, units, shares that are available to be purchased and traded. All 1 billion of us who are interested can't walk into Walmart's office and say, I want to buy one. It would be chaos. So in the US, and also in Nigeria, because we also have a stock exchange as well, stock exchanges evolved. And what was the purpose of these stock exchanges? They became places that you could buy and sell your equity stakes in companies. Genius, right? So the New York Stock Exchange exists. There's the NASDAQ Stock Exchange, also in the US. In Nigeria, we have the Nigerian Stock Exchange, which is actually a company registered not for profit. And so to be listed on these, for companies to be traded and their shares to be traded, units, slots to be traded on these exchanges, you had to be registered with the exchanges. And the exchanges were very helpful. Over time, they played a role in terms of guiding investors, in terms of certain minimal level of good practice from companies. So, for instance, to be listed, there would be requirements, right? You have to have a certain type of board, you have to release annual reports, you have to get audited, you had to be doing good business practice. Now, that doesn't mean that companies that are listed on the exchange are all good companies to invest in. And that is where the S&P 500 came to play. So the S&P 500 are the top 500 companies listed on the New York Stock Exchange by market capitalization. So, third term I'd like us to talk about is government bonds. So I'm trying to think of how to approach this when it comes to government bonds. How about I first start by talking about a bond? So on average, bond durations tend to be longer. So basically what you're doing with a government bond, a bond is a certificate or a document or a piece of paper, whether virtual or physical, that an organization or a government or a person gives you to say, in exchange for you giving me some money, I will give you this certificate or this piece of paper to prove that I have your money, and I promise to give you an interest payment periodically, often twice a year, some bonds are once a year, in exchange for holding onto this money, usually for a minimum number of years. So one of the biggest difference you'll find between bonds and certificates of deposit usually are the tenors. Bonds tend to have a longer tenor than, for instance, fixed income and fixed deposits. So government bonds, all that's changing here is who is the entity. So when you hear it's a corporate bond, it's a bond that's been issued by a company. If you hear a government bond, it's a bond that was issued by a government. When you hear municipal bond, and this is a very commonly used term in the US specifically, municipal bonds are usually issued by municipalities. I think I got that right. And so those tend to be different. A municipality, it got me. Could be like a town, it could be like a city. Even at the city level, they're allowed to issue bonds. So that's just the difference between a bond, I would say, a municipal bond, a government bond, and then I even comparing it to your fixed deposits, your certificate of deposits, your fixed income, all the same thing, and then your high yield savings accounts. Now the category of investments I just discussed with you, all of these investments or financial instruments, financial products, all the same thing. So when you hear them, these phrases are used interchangeably. One of the things that these different financial definition key terms have in common is they don't give you, the investor or the holder, equity. So in essence, you're lending money to these institutions. Plain and simple. That's what a savings account is. You leave your money in a savings account. The bank uses it for loans and different business ventures that they loan to third parties, and they give you a piece of what they hopefully make after those loans, right? So still a savings account is, I'm not using this money, I'm going to leave it with you, you can use it. It's a loan. In essence, in a more basic way to think about it, it's just a loan to the bank. The same with government bonds or municipal bonds. You're loaning money to the government so that they can use it to build roads, they can use it to do projects, so many different things, and then they give you interest as your reward for loaning them this money. And it's the same with a certificate of deposit. So this category of investments, typically, if you're in a traditional, conservative, A-ranked institution, would be considered on average to be low risk investments. Remember that, because it's going to come in handy when we begin to talk about how do you set up your portfolio to diversify your risk. Now, let's go on to more terms. The next category of terms I'm going to talk about are going to deal with more equity, stock, shares, natured investment. Capitalization, what does that mean? Well, let's just say that the 500 largest companies that are listed on the New York Stock Exchange.